Picture this. It's October 22nd, 1907. You walk up to your bank, the Knickerbocker Trust Company, to get some cash. But you can't get in. A crowd of thousands is blocking the street. They are all desperate. They are shouting. They are all demanding their money. You find out your life savings, all of it, is locked inside. You aren't allowed to withdraw a single dime. This was the reality of the Wall Street panic of 1907. In just a matter of days' interest, rates will rocket from 9.5% to 100%. The New York Stock Exchange will lose 50% of its value. And it all started because two men tried to get rich fast. To understand how they almost bankrupted America, we have to go back. First, you need to understand the stage was already set for a disaster. The year 1906. America's economy was already fragile. On April 18th, a massive earthquake devastated San Francisco. It killed an estimated 3,000 people. It caused $400 million in damages. That's over $13 billion in today's money. This triggered enormous insurance payouts. Much of that money had to come from British insurance firms. This shipment of gold drained the reserves from London. The Bank of England was forced to raise its interest rates to protect its remaining gold. The U.S. had to follow. Credit tightened across America. Money dried up. The entire financial system was a powder keg, just waiting for a match. And that match was about to be lit by two men. F. Augustus Heinze and Charles W. Morse. First, meet F. Augustus Heinze. He was one of the infamous Copper Kings of Butte, Montana. He made his name not by building, but by fighting. His target was Amalgamated Copper. This was a massive conglomerate backed by an even more formidable power, Standard Oil. Amalgamated ruled the region with an iron grip. Heinze wanted a piece. In 1895, he bought a small mine called the Rarus, right on the border of Amalgamated's property. Then he launched a war. He buried Amalgamated in over 100 different lawsuits. But while the lawyers fought in court, his miners fought underground. They tunneled directly into Amalgamated's shafts. They broke through, and they stole over $1 million worth of high-grade copper ore. You'd think this was illegal. But Heinze justified the theft by twisting Montana's apex laws. And when that didn't work, he had a backup plan. A local judge, William Clancy, who ruled in his favor every single time. Heinze even convinced the courts that Amalgamated was the one operating as an illegal monopoly. But the endless legal battles drained his resources. In 1906, Heinze cut his losses. He sold his mining rights for a reported $10.5 million. And he took his cash and his ambition to New York. It's here he meets a man who is an even bigger schemer, Charles W. Morse. Morse was known as the Ice King. He had been practicing fraud from a young age. As a teenager, he convinced his father to pay him a $1,500 salary to keep the company books. He then secretly outsourced the entire job to someone else for $500. He pocketed the $1,000 difference for doing nothing. While still in college, he brokered deals to ship ice from Maine to New York City, but he never let his ships return empty. He filled them with southern lumber and coal for the return trip. He made $100,000 before he even graduated. That's $3.5 million today. By the turn of the century, he had consolidated nearly every ice company on the East Coast. He created the American Ice Company, a $60 million empire. That's over $2 billion today. With his ice monopoly secured, he set his sights on finance. He took control of the National Bank of North America. He bought a major stake in the Mercantile National Bank. He wanted to bend Wall Street to his will. When Morse met Heinze, he saw a kindred spirit. Together, they were reckless enough to play a game Wall Street feared. Morse gave Heinze control over a chain of banks and, most importantly, trust companies. This is the critical, fatal flaw in the entire 1907 system. You see, back then, you had two kinds of financial institutions. First, you had national banks. These were heavily regulated by the government. They were legally required to keep 25% of their deposits in cash reserves. They were stable. They were boring. But then you had the trusts. Trust companies were the hot, high-flying, unregulated fintech startups of the day. They were state-chartered, not federally chartered. This meant they faced almost no regulation. They only had to hold 5% in reserves. This low reserve requirement meant they could loan out more money and be more profitable. They could invest in anything: stocks, bonds, risky ventures. Because their costs were low, they paid higher interest to attract depositors. So where did everyone put their money? Exactly. Heinze and Morse now controlled a string of these financial time bonds, and they were about to use depositors' money to fund their personal bets. Which brings us to their grand plan. It was devised by Heinze's younger brother, Otto. Otto was convinced that investors were heavily shorting their family company, United Copper. This means they were betting the stock price would go down. Otto proposed a short squeeze. The plan was simple. He, Augustus, and Morse would quietly buy up as many shares as possible. This would drive the price up. It would force the short sellers to buy the stock back from them at a much, much higher price. To pull it off, they needed a massive amount of capital. And they got it from their associate, Charles T. Barney. Barney was the president of one of the largest financial institutions in the country, the Knickerbocker Trust Company. The trap was set. They started buying. The price of United Copper shot up, but they had made a fatal miscalculation. They didn't control all the stock. When the short sellers needed to buy shares to cover their bets, they found other sources. The trap failed. The squeeze was broken. On October 15, 1907, the scheme collapsed. The stock price for United Copper crashed. The Heinze brothers were ruined. And the banks they used to fund the bet? The banks that Charles T. Barney had loaned them money from? They were now insolvent. This is where a bad bet becomes a full-blown panic. News spread like fire across Wall Street. It linked the failed copper speculators, Heinze and Morse, directly to Charles Barney, and to his bank, the Knickerbocker Trust. If the Knickerbocker's president was mixed up with these men, was anyone's money safe? On the morning of October 22nd, the panic began. We're back to that crowd you saw at the beginning. Thousands of depositors, desperate, demanding their money. The bank clerks worked frantically, handing out cash. In just a few hours, the Knickerbocker paid out $8 million. That's over $275 million in today's money. But it wasn't enough. The line was still blocks long. By early afternoon, the bank was out of cash. It shut its doors. It would not reopen for nearly 5 months. This single failure sent a shockwave through the entire financial system. Confidence was shattered. If the Knickerbocker could fail, any trust could fail. The panic became a contagion. Lines formed outside the Trust Company of America. Lines formed outside the Lincoln Trust. Banks scrambled to protect themselves. They pulled all their money out of Wall Street, cutting off cash to the stock market. Credit, the lifeblood of the economy, it vanished. The interest rate for call money, the overnight loans brokers need to operate, skyrocketed. It went from 9.5% to a staggering 100%. At times, no one was willing to lend money at any price. The New York Stock Exchange spiraled downwards. It lost 50% of its value in a matter of weeks. Commodity prices plunged by 21%. Bankruptcies surged by 47%. Unemployment shot from a low of 2.8% to 8%. The entire U.S. economy was grinding to a halt, and there was no Federal Reserve to stop it. Music becomes serious, stately, and powerful. There was no government safety net. There was no central bank to call. There was only one man, John Pierpont Morgan. J.P. Morgan was 70 years old. He was the most powerful private banker on earth. For the next 2 weeks, he became the U.S. government. He knew he had to stop the bleeding. He summoned the city's top financiers to his personal library, the presidents of the major banks and trusts. They argued for hours. The stock market was on the edge of collapse, but no one wanted to sacrifice their own reserves to save their competitors. Morgan grew impatient. He locked the doors. He literally kept the key in his pocket. No one was allowed to leave until a plan was finalized. By the early morning, a deal was struck. Morgan and his allies raised $3 million to prop up the Trust Company of America, stopping the next bank run. He organized a $25 million rescue fund to stabilize the stock market. He orchestrated another $30 million bond purchase to keep New York City itself from going bankrupt. He, as a single citizen, had become the lender of last resort. He had strong-armed Wall Street into saving itself. Music becomes somber, reflective. Morgan's rescue was ruthless. He refused to save the Knickerbocker Trust. He let it collapse as a public warning to reckless financiers. As for the two men who started it, Augustus Heinze was thrown out of the banking industry. His health failed. He drowned in legal battles and alcohol. He died in 1914, broke. His younger brother Otto was barred from the New York Stock Exchange and disappeared into obscurity. Charles Morse, the Ice King, was convicted of federal banking violations. He was sentenced to 15 years in prison. Behind bars, he reportedly befriended another inmate, a young con man who was taking notes, Carlo Ponzi. And what about Charles T. Barney, the man who headed the Knickerbocker and enabled their scheme? After being forced to resign, he returned to his Manhattan home on November 14th. He took his own life with a revolver. J.P. Morgan was hailed as a savior. But his power terrified Congress. What if one man could hold the entire economy hostage? What if he had been on vacation? What if he had simply said no? The panic of 1907 proved the American financial system was broken. It led to a government investigation, the Pujo Committee, to study this money trust. And in 1913, it led directly to the creation of the Federal Reserve Act. The entire idea was to create a permanent J.P. Morgan, an institution, not a man, that could prevent future panics by providing liquidity. But financial history doesn't just repeat, it rhymes. More than 100 years later, the 2008 financial crisis followed an eerily similar script. In 1907, the unregulated shadow bank was the Trust Company. In 2008, it was non-bank institutions dealing in mortgage-backed securities. In 1907, the shocking collapse that triggered the panic was the Knickerbocker. In 2008, it was Lehman Brothers. In 1907, J.P. Morgan, a private citizen, stepped in to save the system. In 2008, the Federal Reserve and the U.S. Treasury stepped in. The 1907 panic proved the system needed a lender of last resort. The 2008 crisis proved what happens when that lender has to bail out the entire world. Both crises were born from the same ingredients: unchecked ambition, complex financial tools no one understood, and a fatal lack of regulation. So it raises a critical question. The 1907 panic was caused by a lack of a safety net. But you could argue the 2008 crisis was caused by a system that expected a safety net. Which do you think is the bigger danger for our future? A system with no central bank, or a system that relies on one too much? Drop your prediction in the comments. And subscribe, because we're going to dive deep into the 2008 collapse in a future video.